All right, welcome to the first Daily Discernment. This is going to be an almost daily, and I say that because there's not something to talk about every day. So don't expect one of these every day. But on market days where there's something to talk about, like today, I'm just going to go kind of 5 to 20 minute probably video outlining what it is I found particularly interesting that day. I'm calling it discernment because every day that goes by, I feel like we have more and more inputs flying at us, more news, more alerts, more prices, more people talking about all of those things, more people talking about the people talking about all of those things. Really, an ungodly amount of information flying at us. Too much for all of us. I think more and more important every day is the ability to discern from all of that flying at you what is actually important. Is important to me from a AI standpoint too. We all use AI now. We probably all use it more and more. Being able to discern what from the outputs it's giving is important. What makes sense, what you should carry with you, what you should leave behind, what you should have corrected, what you should ask a different AI to steel man for you, etc. Like it becomes really that's the skill set at this point of using AI in this line of work, at least in my opinion. Word discernment, as I used over and over the other day on the Daily Dots, it just gets more and more important to me. So I figure why not call this little show the Daily Discernments. Today, the thing that stood out to me was obviously the Treasury Secretary's, we'll call it manipulation in markets at the end of the day, suppressing yields through buybacks. Huge, huge thing to me today. Now, the actual mechanics of the program, not huge. They can do technically $38 billion worth per year, which is, a drop in the bucket. It means nothing. But the signal of from them that they're uncomfortable with where rates are and they're willing to do something about it, that's far from small. Like we did a lot more than $38 billion worth of damage in markets today, right? You had, gold, silver, Bitcoin, other commodities, some foreign country, ETFs, pick a liquidity proxy, right? Like all kind of ripping higher, hit bond yields. I mean, they only put in a 4-day low, which is not a big deal if we're being real about it. But hey, 9 basis points on a 30-year, not nothing. Almost 0.9% on the dollar, definitely not nothing for one day. It just felt like a really important moment for markets for many reasons. But also, I want to talk a little bit about the way I see the forward-looking view of this from this point forward. At the end of the day, they're doing buybacks, and if you don't know what that means, it literally means they take some cash and they buy back some older bonds. They don't have to just do that in duration, but clearly the point they made today was we're going to do this with duration. So think of it this way: sell some T-bills, very short-term debt, take that cash, go buy, say, a 30-year with it. And some of those really are truly illiquid. So this is a liquidity management tool, not crazy at all. Now, suddenly one day when yields are a problem, doubling it, like kind of obvious what's going on there. Same thing as what's been going on in oil markets where, Pakistan just knows that a deal's imminent, for the fifth time, stuff like that. Not all that different in that sense. One of the reasons it's important to me is because this is too small to work. It won't be long, in my opinion, because I have a very firm view on, some significant inflation coming our way in the next few months, whether that's tech inflation from the AI build out, that's, food inflation because of El Nino, energy inflation because of the war, other forms of inflation because of the war, because it turns out energy is not the only thing that goes through the Strait of Hormuz. We have all these different sources of inflation kind of all seeping into prices right now. Imports and the dollar going down because of this doesn't help. So if you're like me and you see this inflationary backdrop, knocking yields down by 9 bips one day on a kind of one-off announcement of doing more buybacks than you thought we were going to do is not enough to hold back the long bond whenever we get more and more, inflationary data and signs from the market. So if the next CPI print comes in at, let's say the thing's expected to be 0.3 and it comes in at 0.5, the 30 years not going to be like, yeah, but they're going to do some buybacks. Nope, it's just going to blast through new highs, and that's going to put a lot of pressure on the Fed and the Treasury to do, more than some buybacks, aka QE. Obviously, they're not going to call it QE no matter what they do in that environment, but that's what they're going to have to do. They're going to have to use some balance sheet, whether it's the Fed's, whether it's yours and mine, whether it is the banking system. Somebody's balance sheet's going to have to become a big warehouse to store a lot of this duration so that they can cap yields. We've all, well, I should say we've all, most people have known this stuff's going to come for a long time. It's driven our investment decisions for a long time because it's kind of obvious this is where it's all headed. It's the reason people like me like and have owned gold for a long time. For me, it's a reason I am always open to trading crypto, even though I'm not a buy and hold crypto person. Like, because you're going to get too much liquidity at different points because of the stresses placed on the architecture of our market from inflation and from the kind of secondary effects of inflation hitting the deficit and then the deficit hitting inflation and then inflation hitting the deficit in that nasty loop that we have. Some reasons I think this was important, particularly today, was, I wrote a piece 3 weeks ago. If you want to read it, just shoot me an email, chase@pinecomacro.com. I'll send it to you, about the fact that, Kevin Warsh basically said, like, I'm going to have to hike back 3 weeks ago in the July FOMC. I don't need to hike because inflation's doing it for us, is essentially what he said. He said, like those back end rates, they're moving higher, they're tightening up financial conditions. That's doing the work for us. Like, why do we need to do it? And I kind of wrote all the reasons I thought that was wrong. Here we are 3 weeks later, and we're kind of proving that was wrong because we can't actually let the bond market do the tightening for us because it's too problematic, it's too painful. So we're going to have to fix that. Now, if you do this, if you know give some Novocaine to the 30-year, but then you don't raise rates, you don't follow through with the policy rate, then you have the worst of both worlds. And then the rates are really going to want to go, the dollar's really going to want to go. So that whole, credibility thing from the Fed that frankly it gets, overemphasized. And, every time the Fed makes the smallest mistake for the last 30 years, everyone's ready to talk about credibility and how they don't have any and they're going to lose control. And I've been guilty of this myself. Usually nonsense, right? In this case, it might start being kind of real. So that's something to keep in mind. This is also important because if you go back to that presser, you think about Kevin Warsh. He's saying, I want the market to just look at the data and make its judgments there. I don't want it looking at us. Don't look at the Fed, And I think that implies also don't look at the Treasury. Well, if you're not looking at the Fed and the Treasury, you have to look at the data, make up your own mind that way, right? Like, oh, high inflation, like let's go up, whatever. Now, I don't think that's a good idea. I think the Fed should always, or the bond market should also be looking at policymakers. That just makes sense. Unless policymakers are doing nothing, then they're important, right? And in this case, it's policymakers' job to keep inflation down, which means it's the bond market's job to look at the inflation and look at the policymakers and be like, you're going to do something about that, right? And as long as they are, then you can take that into account. I think last month spooked the bond market because the bond market's like, wait, if I'm not looking at you to keep inflation from becoming a long-term problem, and you're saying it's kind of up to me, then I have to overreact as the bond market to any potential inflation. And I would argue we have started to see that to a degree. So his whole, like, oh, I don't want it to look at the referee, I just want it to play the ball. Well, now all of a sudden we have the referee in there, kicking the ball and like making the net bigger. And so we're back to the fact that the bond market has to play both. And I think that will just get worse. I think they're going to have to do some form of QE before long because, as it turns out, inflation is going to be too high. They're not going to be able to let rates go where they need to go, which means rates are going to pressure them, and they're going to have to do something to kind of, euthanize that rate problem by getting it off the balance sheet or on a different balance sheet, which to me is going to be QE, some form of it. And that might happen way faster than people think if market pressures are going to try to take the 30-year up to 6% plus, which I think is possible. Now, if the war ends and El Nino doesn't hurt crops as bad as it looks like it at least could, and other things, not just crops, but we have rivers going dry, so it's hurting transport, it's hurting electricity production, it's the severe weather parts of it, heavy rains in South America that hasn't even really become a big problem yet. There are all kind of ways that could spiral into an inflationary problem, other than just like, oh man, we don't have enough corn in this crop. So that the energy inflation, which is kind of obvious, gas for Europe, oil for everybody, obviously diesel for everybody, which feeds into essentially every price. It's kind of funny. You have AI inflation, which has capital goods inflation, imports running at like 6% plus inflation, which is not something we're used to. You have obviously memory and chips inflation running rampant, electricity inflation running pretty hot. So it's not like it's just a little bit of food and energy that you can just write off and like it'll be over soon. Like, nope, you have tech inflation on top of it. Not to mention, tech is competing with the Treasury to sell long-term debt, which is making both more expensive. This kind of helps that, but it also kind of supports demand for the AI build out, which in its own way is inflationary. And that's another point I'll make is these buybacks, if you think about it, are disinflationary. They push the dollar down, which is inflationary. It makes imports more expensive, right? You can see that today. Go look at commodity prices, platinum, palladium, not just gold and silver and Bitcoin, but platinum, palladium, copper. Like there's a lot of less monetary metals that rip today. It's just how this stuff works. The dollar's down, things priced in dollars are up. Like kind of a 101 thing, right? But also you look at long-term inflation expectations or even short-term inflation expectations. If the authorities aren't going to take inflation seriously and are going to fight against the symptoms instead of the cause, which is what this is today, well, then you have to kind of recalibrate to like they care more about the symptoms than the disease. I have to price the disease getting worse. And I think you saw that a little bit today. At last check on I looked, the 2-year inflation swap was at like 6 basis points, and that's a day with the dollar, or excuse me, oil down. So that to me shows this move by the Treasury is viewed as inflationary. So that is not good for yields. So if you have an inflationary policy that's trying to help bring down yields, and then you get some more inflation, the bond market will be looking at kind of both. And again, I think they're going to get pressured into a QE situation, which is the whole thing's interesting because obviously you go back to Scott Bessent heavily criticizing Janet Yellen for all this intervention and messing with the cadence and the composition of like bond issuance and doing it for political purposes. This program literally ends one day before the election, so I'm not even blaming them. Like it's just what people do, right? You find ways to keep as many economic things as good as you can going into an election. Now I think we're doing it more forcefully in ways that we don't care if they hurt medium and long term, which is more of an emerging market kind of vibe, which we have a lot of these days, where emerging markets they'll just throw money at people going into elections and stuff, even if that's gonna lead to not being able to pay the IMF the money they owed or whatever. Like we've always spent money going into elections. That's just part of how this all works. But I think that stuff's getting more egregious, kind of ratcheting effect. It just gets a little worse, every cycle. One thing I want to mention is the weighted average maturity, which I think is now kind of become the most important chart in the world to watch. Because at the end of the day, if they're going to do these buybacks in a way that lowers that average maturity of the whole debt, and they are also going to just issue less of that stuff, which obviously they're doing, and that goes back to Yellen, more bills, keep duration about the same. And I could even see a situation where we just kind of stop selling 20, 30-year bonds because no one wants them. The price is just not good enough to even do it. I think that would be very problematic. Well, it's gonna be one of those things. Like all this stuff fixes problems for like a year or two or 5 even maybe, and then it makes everything way worse long term. It makes everything more inflationary, harder to pay for, but it's all inevitable. I would argue it's kind of just part of a long term debt cycle, the big cycle, and the way they kind of tend to end. We've been here before. We've had the high debt to GDP and had to burn it down with inflation and yield curve control, like running stuff hot, financial repression, capital controls. All these things are, they're just in our future. Some of them are in small ways. We've already had them even in this cycle. But if you go back to the 40s, we saw it. You name it. It's just kind of the way this stuff works. But watching that weighted average maturity here in the next 2-3 years is going to be important. I think it's going to come down more than people expect because of things like this, because of when they do QE, I don't think they're going to buy a bunch of bills. I don't think they're going to buy a bunch of 2 years. I don't think they're going to buy a bunch of 5 years. I think they're just going to sit on 20, 30, 10-year stuff to keep it from running away. Now, at the same time, I think they would love to cut rates to bring all the front end stuff down, get that interest expense line item down to make the deficit a little tiny bit more palatable. But we'll see how that goes. Obviously, this is bad for the dollar. Especially once we get to the QE part, like between here and QE, like I think markets can kind of unwind some of what they did today and put that pressure back on Bessent. Markets like when markets see softness, they like to hit it, right? Like you see somebody's not willing to fight for something, then man, you just pounce on it. Like that's That's how markets work. And bond vigilantes are called vigilantes for a reason. So now that I think we know roughly this level of bond yields as a bit of an uncle point for the Treasury, I think markets will find a way to go pressure it again. And hey, maybe we have another trick up our sleeve that isn't QE that can kind of build a bridge from buybacks to QE. I'm super open to that. There's all kinds of shenanigans you can do, within Treasury before you have to have the Fed go buying stuff up. But what I will say is, I think a lot of people are going to view this next round of QE as like the last whatever 2, 3, 4, I don't know, lost count, and it's not going to be like this is gonna start not with 1.5% inflation. This is going to start with 4, maybe higher percent inflation. This is going to start with 7, 8% deficits, not 2% deficits. It's going to start with 40 plus trillion in debt, not 15, 20. Like, all these dynamics make it different. The credibility of like, man, we can't cut rates anymore, and we have to do something. That QE, and man, we can't control the bond market. That QE, just those are not the same. So keep that in mind. Something I posted on Twitter today that I definitely want to mention was, we went from saying like the we were letting the bond market kind of like do the hiking for us. We went from saying like, let's keep an eye on on bonds. Let's watch those for signal. And we went from that. Let's listen to the bond market. It'll tell us what to do. We went from that to telling the bond market to shut up because we don't like what it's saying. It's almost like the scene in the Odyssey of going through the siren song, like just being tied to the mast and having to hear the bond market just scream the worst stuff at you. Like, we don't actually want to hear it. So to me, I can see this buyback is almost like putting the wax in our ears. Like, we don't want to hear it. But that has all these other side effects, to include you better hike or you're going to have some problems, I think. And one other thing I'll mention is, and the last thing is, if the thumb that is getting put on the bond market with these buybacks and whatever else comes next is the same thumb that was getting put on oil, then that's a very interesting market signal. It's a very interesting, especially for oil traders, right? But also just inflation traders, which is all of us. If, let's say, the fella at Axios said, "Hey, I'm done. Like, ruining my reputation. I can't do this anymore. Like, you guys got to figure something else out." And let's say, maybe Pakistan said the same thing. Well, you got to find a new way to like keep markets from like punishing you for this war too hard, right? And I think this would be like a natural thing to do. Like, well, all right, well, we can't manipulate oil anymore. Let's go manipulate bonds for a little bit and see what we can do there. I'm not saying that's what's happening. Like, we may have a new jawbone about how like imminent peace is breaking out, and there's gonna be a great deal in the next 18 hours or whatever. That could happen tomorrow, and it could come from Pakistan or Axios. But I don't know. I just get a feeling like, because now we're saying, oh yeah, we're not even talking to Iran. Like, we've gone from like, oh, we're talking and it's going great, to like, all right, we're not talking to them, and then all of a sudden it seems like we're putting our thumb on bonds instead of oil, possibly. Obviously, Scott Bessent can do both at once. I think he can walk and chew gum. But I think it's possible that instead of two thumbs, there's one, and it moved from oil to bonds. Just something to kind of keep in mind. Could be wrong. That could look stupid here in a week, but we'll see how it goes. But that's it for the first episode of the Daily Discernment. And these are eventually, maybe this one, maybe not, are going to end up pushing out to my YouTube feed, or sorry, from the YouTube feed to the podcast catchers. I just got to figure out all the linkages and get all that stuff tied up at the back end. But that's it for me for today, and I'll be back the next time there is something worth, our discernment together. All right, cheers.